What if you could get a one-page report card for any business and know in just a few minutes if it's acing the year or about to fail? Well, you can. It's called an income statement, and it's a financial report card that cuts through the jargon to tell a simple story of money coming in and money going out. The income statement, which you might also hear called a profit and loss or P&L statement, tells you the financial story of a company over a certain time, whether that's a month, a quarter, or a whole year. It's less of a snapshot and more like a short film of all the financial action. Together, we're going to walk through an income statement from the very top line, step by step, all the way down to the famous bottom line, so you'll know exactly how to read a company's performance. Section 1, the top line, revenue. We start at the very top with revenue, or what you might know as sales. This is the total amount of cash a business pulls in from selling its stuff before a single bill has been paid. Let's pretend we run a t-shirt business. We sell our shirts for $20 each. If we sell 1,000 t-shirts in a month, our revenue is a cool $20,000. Simple, right? This is our starting point. Section 2, the first big cost of goods sold. Now, obviously, those t-shirts didn't just appear out of thin air. We had to pay for the fabric, the ink, and the printing. In accounting, these direct costs of making a product are called the cost of goods sold, or COGS for short. If each shirt cost us $8 to make, our total COGS for selling 1,000 shirts is $8,000. Remember, COGS only includes the costs directly tied to creating the products you actually sold. Section 3, the first checkpoint, gross profit. Time for our first big reveal, gross profit. You get this by simply taking your revenue and subtracting the cost of goods sold. For our t-shirt empire, that's $20,000 in revenue minus $8,000 in COGS, which leaves us with $12,000 in gross profit. This number is a huge deal. It tells you how much money the business is making from just selling its products before all the other boring expenses. A healthy gross profit means the basic business idea is working. Section 4, the costs of keeping the lights on, operating expenses. Next up are the operating expenses. Think of these as all the costs it takes to run the business day to day that aren't directly linked to making the product. We're talking about things like rent for the office, salaries for your marketing and admin team, the electricity bill, and your advertising budget. Let's say all of that adds up to $5,000 for the month for our t-shirt company. Section 5, the real profit from the business, operating income. When you subtract those operating expenses from the gross profit, you get your operating income. So, we take our $12,000 in gross profit, subtract the $5,000 in operating costs, and we're left with $7,000 in operating income. Why does this matter so much? Because it shows you the profit made from the company's main business activities. It's a clean look at performance before things like loan payments or taxes muddy the waters. Section 6, the final deductions, interest and taxes. We're on the home stretch. Before we get to the final number, we have to handle a couple of non-operating costs, usually interest and taxes. If our business took out a loan, the interest we pay on it is an expense. After that, Uncle Sam wants his cut in the form of income taxes. Let's imagine for our example, interest and taxes combined are $2,000. Section 7, the bottom line, net income. And here we are, the bottom line. This is the number everybody flips to first. We take our operating income of $7,000 and subtract that last $2,000 for interest and taxes. That leaves us with a net income of $5,000. This is the final profit or loss, the ultimate grade on that report card. But here's a really important heads up. Profit is not the same as cash. Because of things like accounting rules and non-cash expenses, the net income is almost never the same as the actual cash that moved in or out of the bank account. So let's put it all together. We started with revenue. We took out the direct costs of goods sold to get gross profit. Then, we subtracted the day-to-day operating expenses to find our operating income. And finally, after paying interest and taxes, we landed on the bottom line, net income. This isn't just homework for accountants. Understanding this flow helps founders make smarter decisions, helps companies get loans, and helps investors spot a winner. It's the true story of how a business is performing. If this tour finally made the income statement click for you, do us a favor and hit that like button and subscribe to the channel. It lets us know you found this useful and want more videos that make the world of business just a little bit simpler. Thanks for watching.